Uncertainty over the US Federal Reserve's interest rate trajectory keeps stocks soft but ranged. Consumer durables and financials are the weak spots, while capital goods and power eke out gains. Vodafone Idea is looking to conclude its long-awaited fundraise with the launch of its 18,000 crore follow-on public offer on the 18th of April. The offer follows a recent infusion of capital by the promoter group. And Bharti Hexacom lists at an over 30% premium to its offer price of 570 rupees after receiving a strong subscription of almost 30 times the near 4,300 crore offer. Gold climbs to 2,400 per ounce, silver to $29 an ounce, even as copper, zinc and aluminum scale higher. Expectations of a recovery in China supports the move. Well, hey guys, welcome to Halftime Report. I'm Sonia and thanks for joining me on the show. In a bit, Ekta will also be with us. Well, for now, the market is not bad, actually. You'd have to say it has been a pretty steady day for the market. What we have done is we've seen a bit of a downtick at the start because of the global cues, but then the market has recovered from there. Remember, out and out through 2024, this has been a buy on dips market, and it's something that's playing out today as well. A lot of factors that are working in India's favor, of course, but a couple of things in the here and the now that you need to watch out for. There's TCS's numbers later in the evening. There's the IIP and WPI data that comes in. And of course, we had the Bharti Hexacom listing. So many cues lined up. For now, it's not bad at all. In fact, the mid-cap index is now well in the green and it's up almost about 100 odd points. But moving on, in an important development, India is going to begin manufacturing bulk drugs that it previously entirely imported. Notably, Hyderabad-based Aurobindo Pharma will begin producing antibiotic penicillin G under the PLI scheme, and Mumbai-based Kinvan will begin manufacturing antibiotic input clavulanic acid. Ekta has more details for us. Ekta, over to you.
Thanks for that. Penicillin G, an antibiotic which is utilized in treating mild to moderate bacterial infections, has not been manufactured in India since the late 1980s. The closure of domestic plants due to cheaper imports led to India relying heavily on China for Pen G supplies, importing an estimated 30,000 metric tons from the country. With a 2,400 crore plant in Andhra Pradesh and a production capacity of around 15,000 tons per annum, Aurobindo will be commencing trial production shortly of Pen G, and commercial production is anticipated within a few months. Similarly, Mumbai-based Kinvan Private Limited was given the largest PLI project for production of input clavulanic acid, which will begin production this year. The medication is integral in the manufacturing of combination antibiotic drugs, whose most popular brand is Augmentin. India has been dependent on majority imports of this importing around 1,178 crores worth of it in 2021. This will be the first plant in the country and is expected to fulfill 40% of India's requirement when it comes to this particular input. The government's announcement of a PLI scheme for 41 bulk drugs with an outlay of 6,940 crores aims to bolster domestic manufacturing and mitigate dependence on imports, a vulnerability starkly highlighted during the COVID-19 pandemic. In FY22, for example, India imported around 35,000 crores worth of APIs, representing 35% of its requirement, with China accounting for 65 to 70% of this share. Despite a few initial challenges, such as the streamlining of approvals and licensing, the PLI scheme for bulk drugs has been largely successful, say industry watchers. The scheme has seen investments totaling around 3,651 crores as of December 2023. The government inaugurated 27 greenfield bulk drug projects to date. These projects will manufacture 22 bulk drugs ranging from inputs for seizure drugs to antivirals and bacterial infections. Additionally, 11 more bulk drugs are slated for production within the next year. Looking ahead, India aims not only to reduce reliance on API imports, but also emerge as a possible exporter. As per government projections, however, challenges do remain, including the optimization of production levels by companies over the next 2 to 3 years and the potential impact of inflation on the scheme's benefits, including incentives provided to the beneficiaries.
Okay, thanks a lot for that. Well, Sujay Shetty, Global Health Industries Advisor Leader at PwC, is joining in to give us his view on this entire issue. Sujay, hi, welcome to the show. Thanks for joining in. How significant is this move by Aurobindo Pharma to produce this antibiotic penicillin G under this PLI scheme? And also, Kinvan is now producing clavulanic acid. How significant is this move according to you?
Very significant, because if you recall, when the first PLI scheme was given, I think there was skepticism about if people will participate on the fermentation side. That's the upstream side in the layman's language. And that's the side that requires a lot of capex, gestation, maximum, competition from China. And this really helps, set the barometer right, because Pen-G is used for many of the downstream antibiotics, as Ekta just said. And so therefore, if this comes on stream, within the time period that it's expected to, it's a huge step in the right direction. More importantly, if this can be successful, it'll be a model. India always had these capacities, and it's not that we lacked the technology, but over the 90s and the 2000s, a number of cost factors rendered it unviable. So although bringing this up is hugely significant for Indian pharma.
Okay. Sujay, hi, welcome to the show. Just wanted to understand that what could probably be the bottlenecks to this coming on stream. Just a quick analysis with regards to the Chinese competitiveness when it comes to prices. Do you think that would eventually be a deterrent? China would continue to be cost competitive, and hence maybe that could be a deterrent for us?
Yeah, I think of course, I'm not an expert on the Aurobindo project, but generally we did look at all of the fermentation issues in our report, Ekta, which, as you know, was published around the time the government framed its first PLI. Chinese companies do have an advantage because many of the products or the starting materials that you need to produce this, which is base chemicals, China has an incredible size and scale which is unmatched. Its input costs are vastly lower. Our logistics costs are getting better, but we are at 3% compared to their 1%, of course, as we are getting better. And also other things like borrowing costs, infrastructure costs are different. So it's unlikely that the Chinese advantage in price is going to be eroded away, which is why it's extremely important for the government not just to stop at PLI, but to look at other things. There are things around pollution norms. I'm not suggesting dilution, but we must find a way out of that. Faster clearance on pollution norms, deep sea discharge, electricity prices. I think some of these things continue to and should be worked on. And I don't think that PLI should be the be-all and end-all, because these fermentation type projects really have a number of risks over and above the capex portion of it. So I don't see, to a straight answer to your question, the Chinese advantage is not going to go away anytime soon.
Can you tell us what, according to you, is the production capacity of Aurobindo Pharma's new plant in Andhra Pradesh? And in terms of a timeline, what are we looking at in terms of, commercial production of penicillin?
Honestly, I would not be able to answer the question.
You wouldn't know.
That's something's best addressed to them on those 2 points.
Absolutely. Okay, got that. But what are the bottlenecks, according to you, to the PLI scheme?
The ones that I mentioned, I think the PLI, on the whole, has been a success. There have been 2 rounds. The second round was an unqualified success with 25,000 crores coming in. On the first one, which was focused on APIs, as you rightly mentioned, 11 more drugs will come on stream. 22 have already been commissioned, 22 projects. So it is a success. I think there was some initial skepticism on fermentation, which the 2 planned capacities by Kinvan and Aurobindo seek to address. So the problem is not, I think, there. The problem would be, I think, looking beyond the whole ecosystem that make fermentation expensive or otherwise, such as the ones that I mentioned, looking at laws around pollution discharge norms, environmental clearances. These are very important to get right. Incentivizing, it was mentioned about demand and inflation in Ekta's report. I would say incentivizing formulation makers to buy more local APIs, looking at, the Essential Medicines Pricing Act, to make sure that the very cheap drugs, which are 5 and below rupees, are exempt so that you can spur demand. These are some of the structural issues that need to be addressed to get, more investment coming on that side. So as far as the PLI scheme is concerned, I think it has done what it was intended to do. But I think we need to draw in much more investment on the fermentation side if we are to, completely cut off import dependence.
Okay, well, Sujay, just hold that thought. We do have Devang Ajmera of Kinvan who's now joining in. Remember that they will be producing clavulanic acid under the PLI scheme. So it is going to be significant. Devang, hi, thank you very much for taking the time out. If you could just explain to us what is the current dependence on clavulanic acid for India, And when does your plant come up? Once it starts production, how much do you think this dependence could reduce by?
Thank you very much for inviting us. PLI scheme, it is a part of Atmanirbhar, and it is a product linked incentive. So whatever the production we will do on base of cells, government will give us the incentive of 20% of every cell. So our total capacity of clavulanic acid is approximately 400 metric tons. So about the government scheme, 300 metric tons allowed to us for the incentive. So 300 metric ton plus 100 tons we have do the production capacity, and it's around, we as per the scheme, we have given the total investment of 450 crore.
Okay, all right. You've invested around 450 crores. I just
Yes.
wanted to understand as a whole, how much does India currently import of clavulanic acid? And once your 400 metric tons does come on stream, how much will it reduce by? How much will the dependence reduce by? And what would be the cost difference between what we import currently and what you would be producing?
During the 21, it was imported 700 metric tons. The production incentive link was introduced, but now gradually the demand is increased, and currently importing around more than 1,000 metric ton. And our capacity is during 21, our share was around to be approximately 57%. But now it come to be reduced. Demand of India is increased to 1,100 metric tons. So share would be reduced to around 40%.
Okay. All right. All right. That is a significant amount that we would probably reduce
Yes.
our dependence on clavulanic acid, which is a key input for a lot of antibiotics, by around 40% once this comes on stream. So Jay, we leave the last word with you. What is the pipeline that is expected? And net in totality, once all of these, once all the production capacity does come on stream for various different inputs, how much would the import dependence on China reduce? And do you think that there's a possibility of us even becoming net exporters?
Very tough question to answer, but just from data points, 27, it was originally intended to cover 41 KSMs, APIs, affecting about 53 APIs. Of that, nearly 27 are coming on stream. These take time. API are very gestative projects. So, if you go by that simple metric, you've got more than half the products being addressed through the PLI scheme. That I would contend is a major success. How much that would translate into volume and value, I think that would depend on global prices and many other factors such as domestic demand. But in terms of sheer volume and numbers, I think in terms of number of products, you've already crossed greater than 50%. So I think that would be one of the big things. API exports, to address your second point, India's always been known as in terms of chemistry, a very advanced country. We still have the process chemistry skills that can enable us to do anything on that API complexity scale. It would enable exports, again, hard to tell how much. The PLI scheme, however, is for domestic consumption, as I recall, unless they've tweaked it. So, you need to have value addition locally, 70% for non-fermentation and 90% for fermentation. It's designed for exports. It should spur exports, hard to quantify, but I think some of this advantages will eventually kick in over a 3 to 5 year period as these projects come on stream.
All right. Thanks a lot, gentlemen, for joining in and speaking to us about the bulk drug production and what are the key challenges that are underway. Devang and Sujay, have a great weekend. Thanks for being with us. Well, for the market, the mid-cap index, by the way, is at a fresh record high. So don't lose sight of that. Plenty of stocks hitting fresh highs. There's Dixon Tech, which is at a fresh high. Tata Power, NTPC, SAIL, BEL. Of course, Bharti Hexacom is doing very well on day one. So let's take a short break. Lots more coming up on the other side. Stay tuned.
Welcome back. Well, for the markets, a bit sluggish, you'd have to say. Just want to point out a couple of stocks. Spark, for example, should come up for you. That stock has lost ground for the second consecutive day. So it's lost around 5% today. And remember, the stock is up 42% on a year-to-date basis, which was on the hopes of this particular molecule, which has now not reached that successful end stage. And that's the reason why you're seeing the correction come through on Spark for the second day running. But the other stock which is in focus is Bharti Hexacom, which has made a good debut on the Lal Street. It's listed at an over 30% premium to its issue price. Rima is here to tell us more about the listing and the post-listing plans.
Well, this new kid on the block wants to be number one. So he wants to be the top student, at least today. It's a very strong listing. The stock opened with a gain of 32% at 755 rupees, much higher than the issue price of 570. The subscription too for the IPO was fairly strong at nearly 30 times. Now, quick word about the company. Now, this is a telecom service provider company, but it largely operates only in two circles, Rajasthan and Northeast. About 78% of its revenues comes in from Rajasthan. In Rajasthan, it's the number 2 player. In Northeast, it's the number 1 player with a market share of more than 50%. The promoters hold 85% stake in the company, which includes Bharti Airtel at 70%, and the second is a government-owned entity called TCIL, Telecommunication Consultants India, and they have a 15% stake in the company. About the financials, last year, the company ended with a top line of about 6,500 crore. Margins for the company have practically doubled. FY21 margins were at 24%, and in 9 months, FY24, margins have gone up to 49.3%, and that's driven by a sharp increase in ARPUs. ARPUs for Bharti Hexacom are touching their 200 rupee mark, 197. Now, JM Financial has initiated coverage in the stock. They've put a target price at 790, but the stock is not too far away from that. Their key thesis is that ARPUs will continue to compound at 10%. Currently, ARPUs are at 197. According to JM Financial, it could hit 285, so closer to 300 rupees by FY28. The two circles they operate in, Rajasthan and Northeast, they are under-penetrated in terms of their tele-density, or they have fewer high ARPU kind of subscribers. And therefore, according to them, Bharti Hexacom's margins will go up. Currently, it's at 49.5%. They see it going up to 57% by FY30, far away, but there is a margin expansion scope possible, and the compounding in the EBITDA is also going to be fairly strong, and it could even be higher than its peer, Bharti Airtel. Back to you.
Okay, thanks a lot, Rima, for that. Well, Sun Pharma is the top Nifty loser today after the US FDA's classification on its inspection of the company's Dadra unit. Ekta, how damaging is this for Sun Pharma?
Well, it adds to the list of problems that they already have when it comes to the US FDA issues. So for their Dadra unit, Sun Pharma has now received an official action indicated status. Just to give you a background, this particular plant was inspected from the 4th of December all the way to 15th of December. And at that point in time, it was issued around 6 observations. Now the US FDA has determined that the inspection classification is OAI, or official action indicated status, which increases the chances of any kind of regulatory action on that particular facility. So now if in case the US FDA is not happy with the current remediation which is undertaken by the plant, then they could probably escalate this OAI to maybe a warning letter and maybe worst case even an import alert. But that's only if they don't successfully remediate the facility. So the company says that they will work with the regulator to achieve a fully compliant status. So that's what the company has said. But remember that Sun Pharma has been facing US FDA regulatory issues. For example, they have an import alert on their Halol facility since December 2022. They had a directive for corrective action at their Mohali plant, which was issued around a year ago. So I think, in terms of totality, it seems as though there is some kind of weighing down when it comes to Sun Pharma.
Okay, so Sun Pharma down 3.5% right now. But moving on, sources tell us that the SEBI is likely to exempt some public sector banks and CPSEs to meet the 25% minimum public shareholding norms by 2024 August. So this year in August. Sapna has the details for us. Sapna, over to you.
Yeah, hi. So in certain pockets, some of the CPSEs as well as some of the publicly the banks have been unable to meet the MPS norms. But the banks, the narrative is very straightforward, like way back when there was this massive cap infusion of over 3 lakh odd crores via government bonds. So consequently, post that, shareholdings have been above 90% in some of them, above 80% in some of them, and, above 75 odd percent in some of them. But, the short point here is that it's most likely that there will be an extension of this exemption being given by SEBI to some of the market players like these banks and some of the CPSEs as well, which have not been able to meet the 75% MPS norm. And the government take is pretty clear that a policy of gradualism has been followed, or rather these norms have to be met gradually. You can't expect a public sector bank sitting with 93% government shareholding to start meeting MPS in the next 4 months and bring it down to below 75%. So this gradualism has been the approach so far in so many years, and that's likely to continue. So that's one. Second aspect that we need to highlight, of course, is the fact that banks themselves have been raising money through QIPs. And it's not necessary that they'll be adopting the share sale route. At least that's not on the cards as of now. And in any case, when a bank does a QIP and GOI is not participating in that, the GOI stakeholding is already coming down. For instance, Bank of India is a great example. Last year in BOI, for example, government stake was above 83 or 81 odd percent. It's now down to below 75 odd percent. So that MPS norm has been met. So these are kind of things which are there. And this is the practice so far. Rest, of course, the larger call about a stake sale, share sale, how, when, what, valuation, all that will happen post-elections.
Okay. All right, Sapna. Thanks very much for taking us through that. We need to take a short break, but Jay Thakkar of ICICI Securities will join in with some trading ideas. Stay tuned. Welcome back. Well, let's get talking about the technicals of the market. It's a bit of a sluggish day today. Jay Thakkar of ICICI Securities is here with us. Welcome to the show. Well, what's your strategy today, considering that we've had a lot of news overnight from the global space? We have a sluggishness coming in for the frontline indices. Mid-caps are fairly resilient.
A very good afternoon to you, Ekta and Sonia. Well, see, as far as the indices are concerned, I would say that yes, at least for this weekly expiry, we again have a truncated week next week. So, I think that Nifty has a very clear resistance zone of 22,800 on the upside from the expiry point of view. But then, the overall trend, I would say, in the short to medium term is positive. We have a target of, say, 23,400 prior to the elections, and I think that is quite likely to get achieved. From the expiry point of view, I think that 22,800, 22,400, this is the range. Until this range is not broken, I think Nifty might just consolidate within this range. But then Bank Nifty has clearly broken out of the prior range of 48,000, 47,000, and that has shifted on the upside. So I think that in the very near term, 49,000 to 48,000 is the immediate trading range for the Bank Nifty for at least this weekly expiry. But eventually, Bank Nifty 2 is likely to inch towards the levels of 50,000, 50,500 till 48,000 levels are held. It's just that the momentum will gain above the levels of 49,000. Now, we have seen a lot of sectoral rotations and very stock-specific momentum. So I have two buy recommendations for today. The first one is on IEX, which is trading around the levels of 154. I think this stock has clearly provided a nice breakout from a downtrend line resistance. We have seen a good bullish crossover in its short-term momentum indicators. We have seen a good short covering as well in this stock. So it's likely to go and fill up the daily gap of 162, and then above those levels, we can see the levels of 168 as well. So one can buy IEX, placing a stop loss below 148. And the second buy recommendation is on Havels, which I think has clearly broken out from a very long consolidating range. We have seen good long additions out here as well. With a disclaimer, I would say that we have recommended this stock to our clients as well at the start of this one. The stock is trading around the levels of 1534. It's retesting the breakout zone, so it's a good risk at this point of time. With a stop loss of 1473, one can go long on Havels as well. One can target 1600 to 1640 going forward.
All right, thanks a lot for that. Well, that's Jay Thakkar of ICICI Securities. But let's find out what's happening in the F&O market. Nigel is here to give us a quick snapshot of what's been happening today. Nigel, over to you.
Well, that's right. You know, the Nifty has moved to the low point of the day, but actually there's more unwinding of positions if you look at the Nifty futures, because the index is down and also there's no open interest build up. So that's one point. The PCR, we were indicating that, in fact, you know, that one had moved up. It had moved to around 1.3 and all. There was some complacency that was setting in. So that, in fact, has come down now to around 1.1, which is a good sign, actually. You don't want it to fly away to around 1.5, 1.6 odd. That's when it gets to that overstretched levels. When you have a market that's fairly volatile, you're expecting the VIX to move up, and that's precisely what's happened in today's trading session. Two strikes that I'm looking at, the 22,700 call that continues to see a fair bit of addition out there, and there is a writing that we've seen for the second straight session, so keep an eye out on that one. On the downside, the 22,600 put actually is seeing a fair bit of addition in today's trading session. So going by the 22,600 put that's seeing some writing, the first stop loss will come in at around the 22,525 because the premium of there is around 75 rupees. But otherwise, if you're looking at a range, it's 22,400 to around 22,525 odd. The real support, though, and the key trigger on the downside will be if the 20 DMA gets taken out. Till that gets taken out, you'll have to say that this market is still an uptrending market. What about stocks that are in focus? Metropolis, just take a look at the open interest built up out there. Fresh long positions are being seen on that particular counter. While on the flip side, you know, Page Industries, that's normally not very, very active. But that one is seeing a good amount of short addition. You know, if you just pull up the futures plate out there. And open interest is up, the stock is down close to around 3%. While MCX is the one that's looking like it's coming in for a bit of a short covering bound. So that's all the stock-specific action that we're talking about. Back to you guys.
Okay, all right, Nigel. Thanks very much for that. Aster DM is up and about ahead of that board meet where it's going to be considering that special dividend which is taking place today. So that stock is up around 2.5% to watch out for that. We'll take a short break. On the other side, Navneet Munot will join in our special segment, REIT Connect. Stay tuned.
Hello and welcome to our special segment, REIT Connect, where we aim to understand real estate investment trusts and how it can make a meaningful contribution to your diversified portfolio. To understand its importance in the mutual fund space, let me welcome on the show Navneet Munot, the MD and CEO of HDFC AMC. Navneet, always a pleasure to welcome you on CNBC TV18. My first question, since we are talking about understanding REITs and its importance in the mutual fund industry, which has become such a strong force for investment by our investor community, what do you think of this particular asset class as in a diversified portfolio and the meaning of it for an investor?
Thanks, Nisha. Always a pleasure to be with you. You know, there are several transformational forces in the economy that we talk about. Formalization of the economy, digitalization of the economy. In our industry, we have also been witnessing financialization of savings in India. These are the early days of financialization of savings in India. But one of the important trends that we are going to witness, and these are early days, is the financialization of assets. Real estate is a very large part of investors' portfolio or part of the economy. Gold is another one. These are the physical assets which get converted into financial assets that can get transacted, that can get traded in the public markets as well. And the fractionalization where through the regulation and through other means, they get traded as a stock or a bond. This is a very, very big trend. Of course, so far we have only 4 or so REITs and around 4 InvITs, but over a period of time, given the size and scale of this industry and the way regulators have been working, the policymakers have been working to make this asset class a lot more accessible to a larger set of investors in a different way than historically it has been looked at. I think will augurs well for everyone, including institutional investors like us. From our portfolio perspective, I think our participation in commercial real estate through this mean adds to the portfolio diversification, adds to a different source of risk and return, and it's an interesting fit. But as I said, there are just 3 or 4. It's been like a couple of years, and I must compliment the policymakers for doing what they have been doing in terms of increasing the transparency, in terms of improving the regulation and making it more accessible to all kinds of investors, including investors like us.
That's right, Navneet, you well pointed out. It has been a laborious work by the industry as well as the regulators to make it a mainstream product over a decade, I would say. And a lot of effort is really going on into it. In fact, one of the SEBI spokesperson had shared on our REIT Connect that REITs and InvITs can take the scale and size of as much as the GDP of the country in due course of time. So that's what SEBI and the regulators are really aiming for. But in the Indian way of investing, Navneet, how does this asset class and this product really fit in the way of investing for Indian mindset?
So Indians have always had an affinity towards real estate as well as gold, the two physical assets. In fact, if you look at the balance sheet of Indian households, almost 50% would be in real estate and around another 10 to 15% would be in gold. Now, gold is available in financial form like an ETF or a gold fund or even a sovereign gold bond. Now you are seeing the same with the real estate. Through the REITs, they can participate in a commercial real estate. And it's an interesting asset class. You participate in the income as well as in the potential of capital gains. As I said, that Indians have an affinity towards this asset class, but it's better to participate in a form like REIT rather than doing it directly. And it may be difficult for a large number of investors to even participate.
That's right, Navneet. And in fact, mutual fund traction is the cornerstone of its larger adoption. What do you think will increase the traction amongst mutual funds in investing into REITs?
As I said, there are only 4 of them. And if I remember, I think the overall size would be around 80,000 crores or so. The size of all the 4 REITs which are listed. The free float would be somewhere between 55 to 60,000 crores. Mutual funds would be owning anywhere between 15 to 20% of that free float. These are early days, as I mentioned earlier. I think we have a long way to go. Thanks to policymakers, we are seeing an increased transparency levels, but there is a lot more that we need to do to make this as vibrant or a robust asset class the way it has been in some of the other places like United States. As of now, we can invest up to 5% in a single REIT and up to 10% of the entire fund into all the REITs put together, maybe over a period of time, not necessarily today, but as the number of listed REITs increase, as exposure increase, maybe there could be a time to have a relook at that. And I think on the taxation side as well, there could be potential for mutual funds to launch a product which mainly invest in REITs and InvITs, as once we have a more a larger universe available and the size increases. But in that case, the policymakers may have to look at the taxation, that if an investor is owning it through a diversified, professionally managed mutual fund versus owning it directly, how to ensure that there is a level playing field.
All right, so that's one technical aspect that needs to be corrected, Navneet. But equity classification, do you think that will also improve the traction a lot more?
So, I mean, the risk profile of REIT is different than of equity and is still predominantly hybrid in nature. Due to the nature of the underlying asset and the investment, this is partly due to the lower execution risk and stable rentals. On one side, there are restrictions on the external debt, like pure equity. But I think if mutual funds which want to launch a product where bulk of the underlying investment is in REITs and InvITs, if there could be some tax incentive, there would be potential for this asset class to grow faster. Because what you're trying to bring in for retail investors is the benefits of a diversified portfolio, a professional fund management, trying to get a better governance and a better management within the REITs and InvITs. And then, of course, if we top it up with some bit of tax benefit, or at least at par with owning it directly.
All right. So those are the suggestions really coming in from mutual fund industry. Navneet, final question to you. Can't let you go without your comments on the market at the moment, because we are looking at some of the big events like elections, interest rate cycle turning, earnings, monsoon. What is your near-term view on the market, and what are the themes that are resonating most with you?
So, Nisha, when is the last time when we didn't have something like this to talk about? There would be some factors, there would be something happening in some part of the world which will make us believe that there are risks on the horizon. It will never go away. But I think overall, if we look at India's macro, I think they look pretty, in a good shape. From a corporate profitability trajectory perspective, over the next several years, I think corporate sector is ready to participate in the higher growth of India. From a valuation perspective, there are definitely pockets where valuations have run ahead of fundamentals, but over a period of time, what investors need to focus is on participating in the continuous earnings growth, the capability of corporate India to deliver the earnings growth in line or slightly better than the overall GDP growth in India for the next several years. And from a liquidity and sentiment perspective, I think both the continuous flow of domestic liquidity through the SIP mode in mutual fund, and of course the global liquidity, which I expect over the next several decades will continue to chase India as a high growing economy, I think will keep us in good stead. But of course, as you mentioned about some of these factors on the horizon, markets are likely to remain volatile given where the valuations are.
All right. So biggest takeaway coming is that India in a sweet spot, but valuations definitely have run ahead of the fair valuation. All right. Thank you so much, Navneet Munot. Always a pleasure to have you on CNBC TV18. And with your thoughts on REIT as an asset class as well are very, very essential as well as valuable. Thank you so much for joining us on CNBC TV18. With that, we'll slip into a short breather. More on markets on the other side. Stay tuned.
Welcome back. Well, the mid-cap index has also reversed. We have an advanced decline ratio, which is quite sluggish. So around 1,639 stocks advancing to around 2,226, 2,200 stocks declining on the Bombay Stock Exchange. So that, as you can see, has widened just in the past couple of minutes, indicating that there's been a turn in sentiment, at least for the broader market. So currently, not too much to write home about. But if you just look at it on an intraday chart, the mid-cap index has lost ground, but it's still down around 0.2% on absolute basis, or in absolute numbers around 84 points. And compare this to the Bank Nifty, which is down around 370 odd points, the Nifty, which is down around 170 odd points, and the Sensex, which is down around 600 odd points. So relatively unscathed, but nonetheless, there's a reverse in sentiment which has taken place in the mid-caps at this point in time. Let's see whether there's any kind of buying at lower levels. But moving on to some more brokerage calls, Credit Axis Grameen and Intero Healthcare are two stocks which are buzzing on the back of brokerage calls. Intero Health, in fact, is at an upper circuit. It's a recent listing in the pharma distribution space. Sudarshan is here to tell us what these brokerages are making of these stocks.
So both these stocks are sharply higher after these brokerage notes. First, I'll talk about GS on Credit Axis Grameen. GS has initiated coverage with buy rating and target is rupees 1,788 per share, and it implies upside of nearly 30% from current levels. GS says company has demonstrated a good track record through the cycles, and it forecasts a healthy 21% profit CAGR over FY 24-26. And as per GS, key catalysts are: first, company has a diversified loan book; second, it continues to gain market share; and last, it has competitive edge on industry-leading credit costs and operating efficiency. Next is Jefferies on Intero Health. It has initiated coverage with buy rating and target is 1,510 per share, and that implies upside of 25% from current levels, and currently stock is locked at 20% upper circuit. Jefferies believes it's a fast-growing healthcare products distributor operating in large and fragmented market, and it should see 20% organic revenue CAGR over FY 24-26, and it estimates 8 times increase in adjusted profit as economies of scale kick in. And lastly, in addition to that, it should benefit from industry consolidation as well.
Okay, all right, Sudarshan, thanks very much for that. So those are two buzzing stocks today, but NTPC is one of the top Nifty gainers this morning after reports suggest that NTPC Green has shortlisted investment bankers for a possible IPO. Vivek joins in with details on this.
Well, that's right. So the stock in focus, of course, is NTPC. Now, this is largely along expected lines. In fact, in an interview to us, a few months ago, NTPC's renewable energy arm head had also told us that they were looking to go ahead for the IPO for the renewable energy arm, which is NTPC Green Energy. So along expected lines, now Money Control reports that they've gone ahead and appointed the iBankers. They're also saying that the size of this particular IPO would be close to 10,000 crore rupees. So the iBankers being appointed are IDBI Capital, IIFL Securities, Nuvama Wealth, as well as HDFC Bank. What do they need this particular IPO for? Number one, it's largely going to be used for capex. So the company, which is present largely in the renewable energy space, will use the proceeds of this particular IPO to fund ongoing as well as future solar energy plans. Also, green hydrogen plants and green ammonia capex is something that the company is looking to fund via accrual from this particular IPO. To give a sense and to give some context as to what exactly is the size of NTPC Green Energy, overall NTPC capacity is close to 74 gigawatt. Currently, the renewable energy is just around 3.5 gigawatt or 3.4 gigawatt to be precise. But the company has very ambitious plans to go ahead and increase capex as well as increase the capacity it has as far as its renewable energy space is concerned. FY26 guidance is to reach 15 gigawatt of renewable energy capacity.
Okay, all right, Vivek. Thanks very much for that. So that's on NTPC. Even delivery is doing well today. That stock is up around 4.5%. It's in fact rallied around 21% this year. So that one is doing well. A couple of others which stand out is even something like a 361 WAM, which is the wealth management business of IIFL. That stock is up around 2.5% in today's trading session. Take a break. On the other side, Manisha Gupta will be joining in to take us through what she's tracking in the commodity space.
Welcome back. Joining us on the show now is Feroz Aziz. He's Deputy CEO, Anand Rathi Wealth. Feroz, hi. Good to have you. And I remember the last conversation I had with you on gold, and you said gold is at the lowest form at the pyramid. With what gold is done right now, are you changing positions at all? And are you willing to put in some more in case of gold?
Yes, Manisha, see, I think like you rightly said, we from an investment standpoint, India doesn't need too much gold investment because we are, if you look at the 370 lakh crores of physical assets, gold has taken a substantive portion of Indian households. So we are over-invested for sure. Unlike other households in other countries, gold is not a integral part of their usage or even an investment standpoint. So point two I would like to make is, of course, gold is at its peak. Because there is a shift in several central banks, the kind of collection of gold by central banks is the highest in 22-23, highest ever since 1967. Central banks have not collected gold at this pace, unlike just these 2 years where they've collected. So I think there has been a lot of demand. So I think gold should have part of one's portfolio if it's already not there. But most HNIs I meet they have substantive portion of gold already. But yeah, sovereign gold bond giving that 4-5% extra post-tax is a huge kicker and a motivation to buy gold, especially in digital form, in the form of sovereign gold bonds.
So Feroz, when we talk about India, yes, we are perhaps long gold, but in a jewelry form. When it comes to financialization of gold, would you say that there are enough products now available? And do you think India is moving in that direction?
Yes, I think there is a huge paradigm shift in terms of people's thought process. I think both the genders now seem to be liking the digital form of gold as well, unlike in the past. So there has been a huge shift. Of course, it's not got the kind of momentum it should get, point one. Point two, if you look at from a short-term standpoint, if you're buying gold for 1-2 years, and 3 years or even lesser, a gold ETF or a gold fund is a great alternative. If you're looking at a long-term strategic allocation to a portfolio, then sovereign gold bond definitely does the trick. But coming back to your pointed question, I think there is a lot to be desired, but the paradigm shift and the green shoots of that is very, very evident when I interact with several HNIs and even ultra HNI clients.
Feroz, what are you advising clients now on what part of portfolio should be gold? And are you at all introducing silver within?
No, I'm not going to silver as yet because I think getting gold in and sovereign gold bonds are definitely a very, very good motivation to have in one's portfolio. So I would say that it's a great debt replacer for sure. If you don't like the return of debt, especially the taxation of debt, after the introduction of Section 50AA last budget, taxation on debt has become very detrimental. So gold could be as much as 10% of one's portfolio, or at least half the portion of your debt can definitely get into gold.
What is kind of interest that India has shown? I mean, we've seen a huge run-up in gold. Would you say that a lot of Indians perhaps made use of this as an investment? Are there new folios that are getting in? Do you see more interest at these levels also?
Yes, I think at these levels also I'm seeing interest because quite a few people have this huge desire of late of accumulating some degree of hedge to rupee, because rupee has not depreciated as much for the last few years. Because of the interest rate differential, which is called interest rate parity between US and India, has shrunk dramatically. So a point I'm trying to make is, I think HNI is liking gold also for the fact that it acts as a currency hedge. And I think there is a desire to have foreign currency immensely over the last post-COVID, definitely that is propelled. I would say that at these levels also, people are accumulating gold, and I don't think this time around gold has been supported by huge rupee depreciation, which used to be the case for long periods of time.
Oh, absolutely. Feroz, also, I mean, we are in a time, and let's talk about India. We love buying our jewelry. We love going long on equities. Do you see all of that play on for a too longer time? I mean, as you said, almost every asset class seems to be running up right now. How are you looking at a division or a reforming of a portfolio, even if for the near term?
Yes, I think the way China is accumulating gold, I am very, very thrilled because the dollar reserves from 2011 have come down by one third. So I think I'm bullish on dollar gold now because it was stuck in that range. Now I think it's broken out of the range. So I would allocate at least 10 to 15% in gold, only sovereign gold bonds, if you have debt in your portfolio. If you've used other growth assets like equity, and I think that is also done justice, like you said, Manisha, that all assets have run up. I think I'm very happy with the gold breaking the dollar range significantly and decisively.
All right. Feroz, from all the conversations that I've had with you in the past, this is the most bullish that I've seen you in gold. And why not? Because we're trading at all-time highs now. And everybody has an opinion, by the way, in gold. Do you have one on where it's headed?
So I don't have an opinion. I'm looking at it delivering the 3-year long-term average has been 9.3% compounded is the rolling average of gold for this century. And I think it will give you that kind of double-digit return if held in the form of sovereign gold bond, because this 4% I think is underspoken because you get capital gain tax at 0. And if you get 2.5% taxable interest, you're getting 4-5% compounded more in 8 years. So I think even if gold delivered 6, sovereign gold bond on a post-tax equivalent basis is delivering me 10. So it's a great debt replacement. So I've been saying that from day one, ever since sovereign gold bond was introduced 8 years back. So that's my huge motivation.
I hear that. Feroz, thank you as always for joining in and talking about gold this time, where the expectation is that 10% of your portfolio should at least be in gold, or half of your debt replacer can be happening in case of gold, and a double-digit percentage gains is what we can expect. And of course, the sovereign gold bond as the best bet when you are investing in paper gold there. But with that, that's all the time that we have on Halftime Report. Stay tuned for Business Lunch. That will take all the action forward.